In this video, traders, let's look at the rate of change indicator. Stay tuned. Hey guys, very warm welcome to you. Thank you for joining me. All right, so rate of change is a pretty interesting indicator. It's used by some other traders. I've seen some other traders use it to kind of frame the day and to use it as kind of reversal tool. I've gone over the textbooks, guys, if you're interested in kind of textbook way of doing it. But one way that I've found is quite a nice way to kind of bracket your trade. I don't think it's a trigger puller, if that makes sense. You guys know I use a filter and trigger type system. If you've been around and watched most of my videos, you know that's my kind of process. Comes through the filtering process, and the trigger is pulled normally from a price action pattern. So the rate of change is something that can kind of push it through your filter and say, yes, we might be a bit extended, we're looking for a counter trend pullback. But what it also does, it stops you taking substandard type trades. So let's have a look. So if you just put a rate of change into, I've got TradingView here, and I quite like a 3 period, if I'm honest. I think a 3 period is not a bad way of looking at it. Why? Because you kind of get a good view of that's a little bit thick. You kind of get a good view of how the markets move. I'm a big fan of the rule of 3. Now, is there any kind of evidence to back this up? Not really, and I guess someone could back test this and tell me whether it's true or not. But I think markets move in kind of under normal conditions. You normally get these 2 or 3 day cycles. Sometimes we're going to get obviously multiple day runs. Of course we are, and that requires a different strategy to get on those. The one that springs to mind is a 5 period moving average. I've talked about that many times before. I'm going to check out some of his videos if you're interested in kind of seeing my perspective on that. But just in normal conditions, chugging along, no real fuels to the fire. Then 2 or 3 day moves in the thicker markets tends to be what we get. Now stocks a little bit different. We're talking about your big currency pairs. You're talking about your big commodities, your indices. Generally, and I'm keeping this broad, guys. Generally, we kind of see these 2 or 3 day cycles. 3 day move. Sometimes a bit stronger. You might get a little bit of a 4th day, but very often, if you can't start buying on day 3, you're looking at sitting through some heat at the very least. So let's have a look and see what's going on. So if you look at the rate of change, and I've got the rate of change on here at the bottom. One way of doing it is to just kind of be careful and mindful of what the rate of change is telling you. So if you start to kind of put some lines in and go, well, listen, during this period, a normal market condition, slight downtrend, a little bit of a range, a bit of accelerated trend, chop, etc. The rate of change is showing you the kind of movements, if you like. And it's very, it doesn't care whether you're in an uptrend or downtrend. It's just showing you the change. And so we've got a 3 day here rate of change. We can start to see that, listen, when we start to go into the lower zone, and most people will go, right, well, let me have a 0 level here. And there is one on the chart. I'm going to make it a little bit thicker here. And make it a solid line, and we'll just make it like a grey color. Okay, so now we have reasonable framed rate of change, okay, just like the tick index in a way. So what we're looking at here is as the market kind of goes into the upper level, when it starts to flip back over, that's when we might, and I say not a trigger, might consider a trade against the trend, a trend against the trade against the trend. An example. So we start to see some kind of movements down here. It starts to curl up. There's a little bit of a kind of consolidation. If you traded that, you probably are not going to make any money from that kind of thing. Here starts to flip up a little bit. There's a little 2 day trade there. Again, 2 day cycle. Starts to flip back down again. You get a run. Now, okay, we can add loads of rules in here, like let's align ourselves with a trend. Let's do this kind of stuff. One of the thing though is just to not be chasing stuff that's right at the low. Now, listen, you're gonna have exceptions to the rule, of course you are. But if it's right at the low and it's starting to flip up, then you probably don't want to be chasing it. This kind of move is a great example. Right at the lows here, you think you've got a breakout, rate of change starts to flip up the next day. Let it counter trend cycle a little bit. Let it do a move back up. But then you kind of go, right, well, I'm on my downtrend line. I've got a longer term downtrend. We're back to some resistance level. The rate of change has popped up and it's flipping over. Well, that might be a good trigger for you to get short. Same if you're looking kind of here. And the good thing as well, because you're waiting for it to flip down, you can sit through these kind of runs. So this one ran up to its kind of all-time high, but the highest reading it had for a while here. And then it started to flip over and it just stagnated. Again, you're not going to chase it or anything, but then when it flipped back over to the upside, you got a little bit of counter trend move. And you can see the kind of way it works, guys. It doesn't always work well like any indicator, but it can just, number one, stop you from chasing stuff. If the rate of change is really high, relatively high, you probably don't want to be chasing it. If we look at something like, let's bring up an index like the FTSE. The FTSE is ramping on at the moment. It's election fueled. It's vaccine fueled, and a bit of election as well. Whatever, it doesn't really matter what the fuel is. The point is that now we are ramping on. So would you want to buy it up here? You probably wouldn't. If you go now, listen. If there's a momentum ignition type trade, that's different. Quick in and out trade for a breakout, fine. You're not looking at this. You don't really care what the rate of change is doing. But a good way of just keeping you out of chasing stuff, or if you're looking for a two extra day move from here, you might be pushing your luck a bit. Now, this is extreme circumstances, and one of the things, when you've got a catalyst, you can forget all your indicators. You can forget everything. When there's a catalyst, it's a one-way street. Who knows where it goes? Could be going up for 15 days in a row before it has a slight pullback. Could go up, come straight down again. You don't know. But in normal conditions, when I consider these kind of normal conditions, it works quite well. You wait for the low move, you wait for it to flip up. You don't start chasing when it's at lows. You wait for it to kind of flip up, flip back down again before you let it get short. Now, you're not always going to get it right, but it helps you align a little bit with the pulse of the market. Another way to look at it is to move it to a 2 period. I think that's a little bit too noisy myself, but it can still work well for you. You can still kind of use it and go, okay, what's happening? A little trick that I like to use is to look and see what the market's doing. You can look and can see how many kind of bars, persistent bars of the same color we get before it flips over in this market. 3 greens, couple of reds, 3 reds, 3, 2 and 3, bit of a 4 here. 3. This is different because of the it was based on news, but you can see the kind of cyclical nature, and so use your rate of change at 2 or 3 period as you see fit. Let's put in something like the Qs, so the Nasdaq ETF. Again, same kind of thing. You look to see when your rate of change. I think I've got it on 2 again. Let's put it on 3. You look to see when your rate of change is kind of an extreme level, and then you trade when it starts to flip back, or you're at least very, very cautious and wait for a counter trend move. Now listen, if for example you saw this drive lower, you wanted to get short, you don't chase when the rate of change is really, really low. You wait for it to come up and then start to flip over, whether you want to trade it here, whether you want to trade it here, want to trade it here. Now, and if your expectation is for a lower move, so it's not something that's going to give you an amazing signal, but it's something that can stop you chasing markets. It's something that can help guide your trade. You go, yeah, well, I need to see the rate of change at least an extreme if I'm going to take this trade against the trend, or if I'm going to take a pullback and back in the direction. It just helps align yourself with things, not chase things, be a little bit cautious and more careful about when you're trading, your swing trading on a daily time frame. All right, guys, that was the rate of change. Take care. See you next one. Bye-bye.